Hello, and thank you for joining us. We are Team C-Yolo Incorporated, and this is our earnings call for year 11. I'm here with my colleagues, Lucy Clayton, Spencer Sharp, and Caitlin Genshort. Yolo's company strategy is focused differentiation, which is targeting niche markets with our unique and specialized UAVs and cameras. Generally, costs of products will be higher than the industry average. Some internal or operating metrics to focus on with our strategy is first, the PQ rating, which is an indicator that a larger proportion of earnings are generated from core business operations. This suggests that our earnings are more sustainable and less affected by non-operating factors. This provides assurance to investors that our company is generating earnings in a manner that is consistent with our strategy. A high PQ ratio is also seen as a positive indicator of a company's financial health and performance. With our strategy, YOLO should have a high PQ rating, and that is true. YOLO's PQ rating is 6.7, which is above industry average and at the top 25% of all companies. Second is quality of products. YOLO has focused on high quality products with various features. Our features on all products are set at the highest capabilities. Third is innovation or research and development. We have focused a lot of capital and investing in for the long run. This produces a better and higher quality product, which follows our strategy. Finally is sustainability awards. We want to achieve a high number of awards to reinforce our reputation as a socially responsible company. This is a key factor in purchasing decision of companies within niche markets like YOLO. On the right, we have a table of our year 11 metrics compared to our investor expectations. Unfortunately, we have been lower than investor expectations for EPS, stock price, return on equity, and image rating. On the other hand, we have been exceeding investor expectations in credit rating. Here's a couple of reasons why we were negative in many aspects. First was return on equity. We had almost $300 million in cash on hand, which hurt our return on equity. YOLO failed to find ways to lower cash on hand, and this impacts ROE in numerous ways. One is not using enough cash to generate returns for shareholders, and another is that cash was idling for too long, which reduces the amount of net income that is generated relative to shareholder equity. Secondly is earnings per share. YOLO had failed to adjust for exchange risk during the changes in Latin America and Europe, lowering a substantial amount of projected revenue. We also took a hit, as well as adding additional workstations and facilities to adhere demand. Another reason is our stock price was low, is that we was lower due to poor financial performance due to economic trends and failing to adjust for them. And finally, the reason was for our performance was research and development, which we have set at $40,000 in both UAV and drones in this past year.
YOLO's overall strategy is a focused differentiation strategy. Our approach requires targeting a small group of consumers with unique offers. The first thing we did was we changed our prices. Wholesaling pricing was decreased slightly from $375 to $325 for Latin America, $400 to $350 for North America, in Europe, $350 to $300 for Asia. Our changed compensation decisions were paying them slightly less and decreasing yearly raises from 8% to 1% for the camera and 5% to 1% for our UAV drones. We did increase all special contracts to 40%, decreasing our marketing for UAV drones through doing average retail pricing, a retailer discount, PQ rating, number of models, website displays, search engine ads, retail recruitment, and a warranty period. As seen in the images to the right, our market share is fairly small because we're marketing towards a niche market. The above image depicts our PQ rating, which is high, but we are lacking in sales, promotion, and advertising. The second graph shows our lack in market share for the search engine advertising. I will discuss next how we can improve the market share. Our projection for the next year is to make some modifications that satisfy our investor expectations. We want to maintain a credit rating of A+. We can maintain this credit rating by implementing productivity training. This will increase our revenue without increasing costs too high, and we will achieve that A+ score. We are currently only investing $5,000 for the camera and the drone. Increasing our productivity training to $7,000 in both products will also help our company keep up with the demand for these products. In addition to this, our company will expand our UAV drone facilities to meet the desired demand. To increase our earnings per share, our company will repurchase stock. This eliminates excess cash and invests in our company. Repurchasing stock will allow us to maintain a level of control within our company. We'll also initiate dividends at $3 per share. Next, we want to increase our PQ rating for both products. While our PQ rating is higher than the industry average, we believe that we can increase this margin in order to create the best products. We will enhance design features of the camera, such as image quality and sensor size. For the UAV drones, we will increase the battery pack and add extra performance features. Our company has a decent market share in North America, but we want to increase the market share by increasing marketing costs in Asia Pacific and Latin America regions. Another way to do this is by increasing the price of our products in Europe to increase our revenue. Our company plans on bettering the stock supply as well. There's high demand for our products, but we could be doing a better job of increasing the supply. To increase this, we will increase workforce compensation through a larger base wage and increasing our fringe benefits package. We're confident in this plan because by analyzing our company, it's obvious to see where we need to reinvest in ourselves in order to create revenue and a positive brand reputation. Our plan has components that are reducing costs and increasing costs, which will allow us to still profit while maintaining a positive credit rating. I want to thank you all for coming and listening to our talk today. And if you have any questions, we'd be happy to answer them now.